Welcome. In this part of our finance masterclass, we're going to pull back the curtain on how financial institutions really generate their profits. We're not going to be talking about secret trading algorithms or making bold market predictions. Instead, we're going to focus on the underlying structure that allows them to build a consistent, repeatable revenue machine. So let's start by challenging a very common myth. We often think that big banks and brokers make their money because they're just smarter, that they can somehow predict the future better than the rest of us. But is that really what's going on? Is their success all about forecasting?
The reality is, they are playing in an entirely different game. You see, the retail world is often obsessed with prediction. Will this stock go up? Will the market go down? Institutions, on the other hand, focus on structure. They ask a much more powerful question. How can we engineer a system that guarantees us an income no matter which way the market moves?
And that brings us to the core mechanism behind that structure, the interest rate spread. This isn't some complex, high-risk trading strategy. It's the simple, foundational bedrock of how they create stable, repeatable profits even when the markets are completely flat. So what is an interest rate spread? Well, it's a beautifully simple concept. It's just the difference between the interest rate an institution pays to borrow money and the higher interest rate it charges to lend that same money out. Basically, borrow cheap, lend expensive. The profit is locked right into that gap.
Let's use a traditional bank as a perfect example. Think of it as a three-step profit machine. Step 1, they take in deposits from all of us and pay a pretty low interest rate for it, maybe around 3.5%. Step 2, they take that exact pool of money and issue loans, mortgages, car loans, at a much higher rate, say over 9%. And Step 3, they simply pocket the difference. That 5.76% spread is their guaranteed income.
Now, of course, that spread isn't just pulled out of thin air. It's very carefully calculated. Part of it is a premium to cover the risk that some borrowers won't pay back their loans. Another chunk covers all their operational costs, paying their staff, running their branches. And whatever is left over after all that, well, that's their reliable profit margin. It's a process, not a prediction. Okay, so that's the banking world. But this very same principle is applied often with even more force in the world of stockbroking. They use the same spread concept through something called margin lending. And this chart just lays it out so clearly. Look at the typical spreads for bank loans. They're in that 3 to 6% range. Now, compare that to the spreads for margin lending from brokers. As you can see, they absolutely dwarf the bank spreads. We're talking about a completely different scale of profitability built into the structure. To put a real number on this, one of the largest brokers in India charges an annual interest rate of about 14.6% for their margin facility. Think about that. That's a massive cost that a trader has to overcome before they even begin to think about making a profit. But here's where it gets even more powerful for the broker. Unlike your car loan where you make a payment once a month, this margin interest is usually compounded daily. And even more critically, the broker has the ultimate safety net, automatic liquidation. If your position goes against you, they don't need to call you or negotiate. They can just sell your assets to cover the loan, instantly. This whole setup creates what we call a structural asymmetry. It's a fancy term, but it just means there's a fundamental imbalance baked into the system. The relationship between the broker and the retail trader is not a level playing field. Let's just break this down. For the broker, their revenue is guaranteed interest income. Their risk is almost zero because of that automatic liquidation power. All they have to do is manage the collateral. Now look at the trader's side. They have to take on all the market risk, and they absolutely must generate a return that beats that huge 14.6% interest cost just to get back to zero. The broker doesn't need to predict anything. The trader's survival depends on it.
And this really is the core idea. The system is designed so that the institution profits from the structure itself, regardless of whether the market goes up or down. The retail trader, however, only profits if they are right. It's an enormous disadvantage right from the start.
So you might be thinking, okay, I get it, but how does this turn into such massive profits? The answer is one of the most powerful forces in finance, scale. This is where the real magic happens for the institution. For one single trader who borrows 1 lakh rupees on margin, the daily interest cost might seem tiny. Maybe it's just 40 rupees. It's so small, it's easy to dismiss, right? You might not even notice it. But now, multiply that tiny 40 rupee charge by tens of thousands or even hundreds of thousands of traders all using margin.
that almost unnoticeable daily fee suddenly explodes into an estimated daily income of over 2 crore rupees for a large broker. That is the incredible power of scale.
And that's exactly why institutions are obsessed with process and scale. Why would you want the stress and uncertainty of trying to make one huge, risky prediction when you can build a system that reliably earns you a tiny, certain profit millions of times over, day in and day out? It's simply a better business model. Now, the fuel for this entire margin lending system is, of course, leverage. And it is absolutely vital that you understand this one truth. Leverage is never, ever free. It always comes at a cost, and it always amplifies your risk. The appeal of leverage is obvious. A 10% gain on a stock could feel like a 20% return on your own money. It feels great. But that sword is double-edged. A 10% loss doesn't just become a 20% loss of your capital. It becomes a 20% loss plus all that compounding interest you still owe, digging you into an even deeper hole. And this is where it can become truly catastrophic for an individual. As this chart shows, a 33% drop in a stock, which might be a painful but survivable event in a normal account, can translate into a devastating 66% loss of your personal capital in a leveraged account. Leverage doesn't just amplify losses, it magnifies them with brutal efficiency. Okay, so we've gone through the mechanics of how this all works. Let's step back and summarize the most important practical takeaways. What does every investor really need to understand from this? Here are the key principles to burn into your memory. First, interest is a non-negotiable cost. You pay it before you even have a chance to make a profit. Second, the financial structure you choose to operate in is far more important than how good you are at predicting things. And finally, one of the biggest mistakes retail investors make is ignoring this cost of capital. Remember, institutions win because of their process and scale, not because they have a crystal ball. So, understanding these interest rate spreads gives us our foundation. We now know the guaranteed fixed cost of using leverage, but this sets the stage for a much more dynamic and, frankly, a much more dangerous combination. So the question we have to ask next is, what happens when you combine this guaranteed cost with the wild, unpredictable nature of market volatility? That is exactly what we will deconstruct in the next chapter.